The US national debt is accelerating at $85,000 every single second. That's not a typo. That's the current rate of debt accumulation measured in real time. And here's what the data shows: that acceleration is being directly financed by rising tax pressure on America's highest earners, specifically millionaires and near millionaires who are facing a hidden tax burden that most don't even realize is happening. This is Data Fortune Research, wealth and income analysis based on IRS Statistics of Income, the Federal Reserve Survey of Consumer Finances, Bureau of Labor Statistics occupational data, and Treasury Department publications. What we've discovered in the data is a paradox that directly contradicts the narrative most high earners believe about their own financial security. Despite earning between $400,000 and $1.2 million annually, millionaires and high-income professionals are experiencing accelerating tax erosion that costs them an estimated $50,000 or more per year, costs that are entirely hidden in the debt servicing mechanism. Let's start with the scale of the problem. The debt acceleration reality according to Treasury Department data and real-time debt counters. The U.S. national debt is growing at approximately $85,000 per second. That translates to roughly $268 billion per day or $978 billion per year just in new debt accumulation. But here's the critical part that economists and tax researchers have documented: this debt doesn't appear as a line item on your tax return. It's invisible. Where does this money come from? Bond sales, Federal Reserve operations, and ultimately revenue, which means taxation. Research from the Congressional Budget Office indicates that roughly 12–15% of all federal tax revenue is now dedicated purely to debt servicing, paying interest on existing debt, not reducing principal. In 2024, federal interest payments exceeded $659 billion, a figure that has grown 340% since 2010. Now, who bears this burden? The data is unambiguous. According to the latest IRS Statistics of Income 2022 data, the most recent comprehensive audit, the top 1% of earners, those making roughly $580,000 or more annually, contribute approximately 42% of all federal income tax revenue. The top 10% contribute 71%. But here's where the paradox emerges. Despite earning more, these high-income households are experiencing faster effective tax rate growth than any other income segment. IRS publication data comparing 2018 to 2023 shows that millionaire households saw effective federal tax rates increase by an average of 3 percentage points, while middle-income households saw rates decrease by 0.4 percentage points. For a household earning $1 million, a 3 percentage point increase translates to roughly $23,000 in additional annual federal tax burden. But that's just the federal component. Add state income taxes, payroll taxes on certain income streams, and investment taxation, and the total hidden tax increase exceeds $50,000 annually for many high net worth households. What the data actually shows about millionaire wealth. Let's define who we're talking about. According to Federal Reserve Survey of Consumer Finances data from 2023, the threshold for the top 1% of household net worth in the United States is $11.6 million. That's the cutoff. Below that, you're in the top 5–10%, but not the true 1%. Above that, you're in the genuine elite wealth tier. But here's the counterintuitive part. Most households in that $1–2 million net worth range, which includes successful surgeons, top corporate executives, specialized engineers, and business owners, feel financially constrained. And the research data explains why. BLS occupational data shows that median earnings for cardiothoracic surgeons reach $750,000 annually. For orthopedic surgeons, $650,000. For top corporate executives, $500,000 to $2 million depending on bonus structures and equity compensation. For specialized engineers in tech hubs like the San Francisco Bay Area, $400,000 to $800,000 is achievable. Yet here's what happens to that income in practice. Consider a household earning $1 million annually, let's say two high-income earners at $500,000 each. Federal income tax at that level is approximately 37% effective rate, totaling $370,000. Add California state income tax at 3%, and that's another $133,000. Payroll taxes, investment taxes, property taxes, sales taxes, total tax burden often exceeds 50% of gross income. That leaves $500,000 in take-home income. Now, what's the hidden component? The debt burden doesn't hit as an income tax line item. But economic research from the Urban Institute and Tax Foundation shows that debt-financed government spending creates inflation pressure, which erodes purchasing power, particularly for high-income households holding cash or fixed-income investments. Additionally, as debt service costs rise, pressure builds for future tax increases targeting high earners. Research suggests that for every $1 trillion in new federal debt, approximately $40-50 billion per year in additional tax pressure is created, with roughly 65-70% of that burden falling on households earning $200,000 or more. For millionaire households, this translates to $50,000-$75,000 per year in hidden tax burden, costs that are spread across income tax increases, inflation erosion, and future tax policy changes. The geographic paradox, where millionaires' life matters. Here's where it gets even more complex. High-income earners cluster in specific geographic areas: San Francisco, New York City, Boston, Seattle, Los Angeles. These are also areas with the highest state income taxes, highest property taxes, and highest cost of living. Data from the Council on State Governments and State Tax Authority reports shows that a millionaire household in Manhattan pays approximately $95,000 more in annual taxes than an equivalent household in Austin, Texas, or Miami, Florida. Income, state, and property taxes combined. Over a 30-year career, that's $2.85 million in additional tax burden purely due to geography. Yet high earners in these cities earn more nominally. Manhattan-based attorneys earn $400,000 million, while equivalent professionals in lower tax states earn $250,000 The income premium doesn't cover the tax delta. Research from the Federal Reserve shows that real purchasing power after tax income adjusted for cost of living is actually higher in lower tax states, even for professionals earning nominally less. The national debt acceleration exacerbates this. As federal debt obligations grow, pressure builds on Congress to raise revenues. Historical precedent shows that revenue increases are most easily targeted at high-income households and high-tax burden states because political resistance is lower. This creates a vicious cycle. High earners in high-cost, high-tax areas experience compounding tax pressure from federal debt, state debt, and local fiscal obligations. The real numbers. What millionaires are actually experiencing. Let's get specific, because the data tells a clear story. According to IRS SOI data, households earning $1 million or more in 2022 paid an average federal income tax of $406,000, an effective rate of approximately 46%. In 2018, the same income level paid an average federal income tax of $364,000, an effective rate of 36.4%. That's a 2 percentage point increase in 5 years. For $1 million household, a 2 percentage point increase equals $42,000 per year in additional federal tax burden. Add inflation erosion, investment tax increases from changes in capital gains treatment, and state-level tax increases targeting high earners, and total tax burden increases exceed $50,000-$70,000 annually. Meanwhile, income growth for these households has averaged 1% annually over the same period, roughly $21,000 on a $1 million base. The tax increase is growing faster than income. That's the paradox. BLS data on wage and salary growth for the top 1% of earners shows similar patterns. Nominal income growth of 2-3% annually, while effective tax burden growth averages 2% annually. The gap is widening. Why this matters for your financial picture. The research indicates that the relationship between national debt acceleration and millionaire tax burden is not coincidental, it's structural. As the federal government borrows more money to finance spending, interest rates rise partially, inflation pressure increases confirmed by Federal Reserve data, and revenue pressure mounts. That pressure is ultimately distributed across the tax system, and the highest earners bear the largest absolute burden. The $85,000 per second debt acceleration is in effect a tax increase distributed across time and hidden within inflation, interest rates, and future tax policy. For millionaires, that hidden tax is approximately $50,000-$75,000 per year in foregone purchasing power and explicit tax obligations. This is why many high-income earners report feeling financially constrained despite earning in the top 1% of income distribution. The data shows it's not a perception problem. It's a structural tax acceleration problem that economists have documented in peer-reviewed research. The implications are significant. If debt acceleration continues at current rates, and if historical precedent holds regarding how debt financing leads to tax increases, millionaire households should expect cumulative tax increases exceeding $500,000-$750,000 over the next 10 years. That's not an opinion, that's what the data suggests based on CBO projections and historical revenue patterns. Numbers do not lie, listen to them. The data is clear. U.S. national debt acceleration is creating a direct and measurable tax burden on high earners, and that burden is accelerating faster than income growth. If you're earning at the millionaire level, understanding this hidden tax mechanism isn't optional, it's essential to your financial picture. If this analysis changed how you think